Okay, welcome everybody. My name is Jerry, and today we're talking about futures trading. And I'm glad you can join me. This is a free video, guys, so it's obviously probably going to be on YouTube and maybe some other platforms, but for sure at least on YouTube. So I'm glad you could join me today. We're looking at futures trading, specifically the E-mini light sweet crude oil futures. If you look up here in the left-hand corner, you'll see the symbol is /QM. So that is basically the E-mini light sweet crude oil futures. And you can see here the tick value, $12.50 per tick, and initial margin is $2,351. Actually, it's a little bit high. I think it's a little bit higher than this because this is on the simulated trading account, that paper trading account. But the real account, I think it's about $2,500. I think it's about $2,500 right now because there's been a lot of volatility in crude. So let's talk about this today. Now today, which is December 7th, 2018, so the year's just about over here. OPEC just came to agreement with Russia to cut about 1.5 million or 1.25 million barrels a day to stabilize the oil prices because they've just been on a look right here on the screen. You can see that crash course. It's just been straight down since. We're looking at the weekly chart here. And by the way, for those of you who are not familiar with this platform, this is the Thinkorswim platform on TD Ameritrade, also known as TOS. Really nice platform. So anyway, since the week of 10/8, this oil prices have just crashed. Week after week, 1, 2, 3, 4, 5, 6, 7, 8 weeks in a row. Crasho. And at that time, back in October, the high was about $75. And you can see to the right here, it's trading at around 53. But it got as low as 49. Okay. And then just today, they made a deal. The OPEC and Russia made a deal, and prices rebounded from about $50 all the way up to about 53. So let's talk about this. You can see in front of you, you see some symbols on here, some little rectangular boxes. I've talked about this before in my other video for the Russell 2000, but I've been trading the /QM futures because I really like the margin requirement's pretty low, and you can get multiple contracts going without killing your account. So you'll see here there's a sell, and of course it happened. Look at the sell signal, guys and gals. Is that perfect sell signal or what? I mean, it was spot on, and it's been beautiful ever since, right? And we're going to talk in a minute where I think oil's headed, okay? But there is a logical set of rules behind these signals. It's TOS allows you to script a language. There's a scripting language that goes along with this. I'm a software developer, programmer by trade for about almost 34 years, 35 years. Been doing that. Hopefully soon retired. And the logic behind this is it's a custom logic I built, and no, I'm not going to share it publicly. Too bad. But it's really, really accurate. It's been working really good. Both in up markets and down markets, the signals have been good. Probably 8 out of 10 times, maybe even 9 out of 10 times. Been really very good. And I'm talking about tracing back over 20 years. So not just in up markets, but down markets too, right? I mean, look at this sell signal here. Now you'll see a buy signal right here, but it's colored yellow, which means be very cautious. And sure enough, I wouldn't have bought this because look, it just kept going, right? So here's a buy signal that's yellow, and there's some other indicators that I use. I'm not showing here because I don't show it publicly. I'll probably eventually. We're a small group of traders right now. It's just 2 of us that are trading. We're going to expand in 2019 probably, and maybe bring on another trader or 2. We'll see how that goes. But So there's some other indicators that we use, but I'm just not showing it in this video. So we're probably going to do a subscription service at some point for those that are interested, and you could subscribe, and we'll tell you when we think it's a good time to get in, good time to get out. I mean, we don't really want to give advice because we're not allowed to do that. So let me just put that out there. I'm not a broker. I'm not a financial advisor. I'm not telling you when to buy, when to sell, but these are signals I use, and you can decide for yourself whether or not you want to follow along, right? That's the way I'm going to put it, okay? Because I don't want to be held liable for telling, oh, some guy told me to buy and sell. So we're not going to do that. We're not going to give you advice to buy or sell because we're not allowed to do that. But we're just going to say, hey, we're sharing our information with you. You decide for yourself, okay? And we're allowed to do subscription services for information. Okay, and you guys and gals out there, do you think that what you're seeing in front of you is accurate? Then we'll be more than happy to accommodate with providing information. Okay. All right. So with that being said, let's take a look back real quick. Just see, we're looking back about almost 2 years here. We can go back further if necessary. Okay. This is a weekly chart. So this sell signal here was pretty clear, right? This sell signal was going to make some people a lot of money, and I'm sure it did make a lot of money for a lot of people. For those not super familiar with futures, I actually think futures are a lot more profitable than stock, buying and selling stock. I mean, nothing wrong with stock. I do that too. Even bonds, okay, options as well. But futures for us is where we make the real money, and that's where we do the bulk of our trading. So if you're not familiar with futures trading, we can dive into that in another video. But for now, let's continue to take a look at this, okay? So sell signal there obviously was very accurate. This buy signal was a cautious buy signal, but still very accurate. Now, orange is our version of red, which means we would be very, very cautious about placing this trade. We probably wouldn't have placed this trade, but even though it was a very cautious signal, it still was profitable. So you could decide for yourself, think of it this way. The oranges are red, so red, yellow, and green, right? Basically stop or don't do it. You could do it, be cautious, and this is pretty much you can go ahead and do it. Now, we're not going to sit here and tell you that we're always right every time, but we're right very often. Okay, here's a sell signal that we were very, very cautious about. I personally don't think we would have made this trade, but it still turned out to be really good. Then we got 2 buy signals within a matter of 1, 2, 3, 4 weeks. And boy, were they really good. Look at that. Here's a sell signal that was wrong, guys. So like I said, we're not always going to get it right. Here's a sell signal right here that definitely was wrong. And so occasionally you're going to get caught out. But the real question here is, if you got 8 good trades and you got 1 bad trade or 2 bad trades, you do the math, right? The 8 good trades are going to outweigh the 2 bad trades, every time. So just looking back here, 1, 2, 3. I mean, if we just count the green trades, the greens most, and stay away from the other 2. 1, 2. We'll call this just 3 because it's basically the same trade. 3. Good 4. This one was good 5, good 6, good 7, good 8, good 9, and then 1 bad. So out of the 10 trades that were all green, 9 were good, 1 was bad. Now, if you mix in the yellows, 1, 2, 3, 4, 5 is good, 6, I'll break even, maybe make a little bit, so we'll just call that neutral. 6, 7 good, 8 marginally good, 9 good, 10 good, 11 good, 12 good. 12 good, 1 bad, and 1 neutral. So there you go. You got 10 out of 12 trades that are basically going to be very profitable. Only 1 was bad, and it really was. I mean, check it out. I mean, as soon as you got to this next week, you knew you were in a bad trade and you get out, okay, right? And then let's see, where was that sell signal? This sell signal, even though it was just a little bit iffy, it still made a little bit of money there. Because you got to remember, this is on a weekly scale. So even if we got in this trade right here at 48, 85 on the close. It went all the way down to 45. So that's 3 full points. Okay, so that's quite a bit. Okay, each point in the QM/QM is $500 per contract. So if you got a two or three contracts going on or more, you just multiply the 500 by that. So even if you were doing a one lot contract, that would have been approximately $400 to $500 in 3 weeks. I'm not saying you're killing it, but at least you didn't lose money. Now, if you had a 3 contract trade going on, $1,500 over 3 weeks. I mean, it's nothing to sneeze about. It's a nice little pocket change. We're small traders and we don't put on a lot of lots because we're limited in what we got and what we can do. But we tend to do a little bit more day. We don't like. There's no such thing as day trading futures. For those that are not familiar, day trading is an stock equities terminology. There is no day trading nomenclature designation in futures. Okay, you can buy and sell equally. In futures, you don't have extra margin requirements on the short side. So in either direction, guys and gals, with futures, up or down, you can buy, sell, you can go long or short. It's the same margin requirement. Okay, so that's one of the reasons we really like futures. Now there's risk. We're not going to try to blow smoke up your backside. There's definitely risk. If there's big price movements, that's a lot of money moving. But that's why we have our algorithm here to help us make good trades, right? And as you can see, it's very, very accurate. All right, let's go back. Let's go way back, like because this is pretty much all these signals are in an uptrend market where the market's trending up. So let's go look at something that was trending down just so we can see whether or not this thing holds water. Is it still accurate? So starting from here to there, it looks like you can tell it's pretty much going down the whole time. So let's count from the top here, right? We got one, definitely good signal there. Even though it was orange, this is actually a very good trade, right? Even over here, this turned out still to be good. So let's count this up. We got 1, 2 good, 3 good. We didn't get a buy signal here, okay? So 1 good, 2 good, 3 good, 4 is good. This is marginally good. It was good, not by much, but it was good. So that's 5. 6 is good up to there, and then 7. You can see that. Okay, this buy signal here is yellow. As bad as I shouldn't say bad because for us the traders that the 2 traders that we have in our little partnership, and more to expand in 2019, we hope. For us, when we look at this right here, this yellow buy signal, and we realize how significant this downtrend is, we wouldn't have bought this. Okay, and we don't view up as better than down, guys and gals. We do not view up better than down. That's kind of amateur hour. No offense to those that only like to go long, but we do not view uptrends better than downtrends. There's opportunity in both directions. You need to get that into your mind. There's money to be made going up and down, particularly in futures. Okay. So anyway, getting back to this, we saw that there were 7 good trades. Not one of these signals in this downtrend were bad. Every single one of them were good. There was one that was weakly good. I mean, I would say weakly. I mean, it wasn't very strong, but it was still good. I mean, there wasn't a lot in it, but it was still good. This little uptrend right here. Okay. A little uptick, I should say. So these are what we call, you're buying on the back side of the trend, right? The overall trend is down, right? But you're buying on the back side, the pullbacks. I mean, there's risk there. You normally want to trade with the trend, okay? You normally want to be trading with the trend. Now, to be honest with you, just about all of your indicators at this point probably would have said you're trending up over it from here to here. That's why you got to have some foresight, and that's why you got to have some good algorithms like we have here to keep us on track, okay? I mean, from here to here, we're looking at kind of a choppy, right? Everybody can agree from here, this was way back in 2012, all the way through to about 2013. March of 2012 to September of 2013. Again, just pretty kind of a choppy looking market, right? It's moving sideways. So let's take a look at that. So we've looked at downtrends, we looked at uptrends. Let's see what it does in a market moving sideways. Again, this is a weekly chart of the E-mini light sweet crude oil futures. Okay, let's start over here. Good signal. I'm going to call that a bad signal. Okay, that's not a good signal. There's a little bit of money there, but let's call it a bad signal. So we got one. I'm going to count all the good ones and come back and count the bad ones, okay? So one, this is a good one. Two, we wouldn't have done this, but if you did, that's a good one. Three, obviously. Four all the way up to there is good. Okay, we'll come back. That's a bad one. This is good one. Five. This is good one. Six. This is a bad one, so we're not going to count that one. This is a bad one, so we're not going to... Well, that was actually not bad. This is about a little bit of money can be made here because I noticed that the high is lower than that high and the low is lower. So there's money to be made in that one. So we're going to count that as 7, right? Here, this is about break even. Okay. And then obviously that one's really good. Okay, so we had 7, maybe 8 good trades. 8 good signals. Let's go back and count the bad ones. That's bad, that's 1. That's bad, that's 2. That's bad, that's 3. That one's just okay. That one's just barely okay. Okay? So we're going to say we had 3 bad trades. Let's count them up again. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. So you had 9 good trades and 3 bad trades, guys and gals. So again, you tell me. Are you going to make money on 9 good trades and 3 bad? Yeah, you're going to make money on 9 good and 3 bad. So, I mean, I don't really trade these very long-term trends, but I know a lot of other people do. And I know that there's people out there who are more like, they're investors, they're not really traders. The difference being investors tend to get into positions and hold them for very long. So if you're an investor, okay, or you could do trading here, you know, but this is over a period of weeks we're looking at here. I tend to trade actually the 5-minute chart, so you know there's a big difference, right? But if you want to hold positions long and that's your thing, then you'll just look in front of you. Okay, the signals work. So we've looked at 3 different scenarios here. You know, a down market, an up market, and a choppy sideways market, and every time the signals have gotten us 9 out of 12, 8 out of 10. I mean, you know, let me just do a quick calculation on what exactly are those ratios. Okay. 9 out of 12 in a choppy market, guys, 75%. And by far, what we're looking at in front of us right now, the choppy market's the hardest one to trade, right? So if you're hitting 3 out of 4, 75% in a choppy market, you're doing really well. Okay, the other ones, I think we had a 9 out of 10 and an 8 out of 10, so that's 80% and 90%, so that's killing it. Now, we haven't actually started up the subscription service yet, but we will. Okay, so let's take a look. Like I mentioned earlier, where do we think the market's headed for the light sweet crude? Now, you could trade the /CL or /QM. Now, we tend to trade right now the /QM, the E-mini, because it's not quite as volatile, and the margin requirements, I don't remember what let's you know what, let's take a look. What is the CL? The CL is light sweet crude oil futures, and yeah, see the margin requirement there is $4,700 on TD Ameritrade. Okay, and it's $10 a tick, which on the QM is $12.50 a tick, but the initial margin on the QM is much lower, so we prefer to trade that. Now, we don't get as much price movement, right? You're not going to get as much volatility because you can see that the trends and are exactly identical, right? There's no difference between CL and QM. They move exactly the same. They're perfectly synchronized because it's the exact same product. It's just the way it's divided out, right? So for QM, you can see here it's like I said earlier, this is a little bit off. It's not 2,300. It's currently 2,500. It's just this is the paper trading account, and they don't update this quite as often, I guess. Okay. So earlier I talked about where are we headed? Where do we believe? H&J believes. Let me tell you what we believe where we're headed with the oil prices on these futures contracts, QM futures contracts. Where are we headed? So we believe this was a low right here on the week of 11/26. Okay, particularly now that today, as I mentioned earlier, today the OPEC and Russia agreed to cut a 1.25, I think, or 1.5 million barrels, okay, a day to stabilize oil prices. So with that being said, that made a big impact on the market. So I believe now that we're going to get a pretty decent uptrend here from between now, we're in December of 2018, so going out to about March of 2019, we think we're going to see oil prices hit about $55 to $60. I mean, maybe as much as $61. Okay. Now we did a deep dive and analysis of oil going back all the way to 2006, from today, this week, all the way back to 2006. In addition to our signals we have here, we did a deep dive, and we looked very carefully at some data and some indicators that this algorithm uses actually from these signals. Okay, and what we discovered is about an 80% an 80% rebound tends to happen based on this exact scenario that we've seen about 5 times since 2006. Okay, so 80% of what? 80% of the high that we had right here at the top, and that was at $76.90. So we believe we're going to get back to about $60, maybe just a little bit higher, about $61. Okay, right now we're at 53. So even if we're a little off, and we believe it's still going to hit the high 50s. Okay, there is another scenario where this actually goes really bad and goes down, but with OPEC cutting the production of oil, we believe now it's more favorable to go up than down. The down scenario would be really, really bad. Well, I shouldn't. Again, I don't like to use bad because we make money up markets and down markets. The down scenario would be down into the 30s, mid to low 30s, with the highs about $40. We don't think that's going to happen now. Okay, so about $61, somewhere between like $58 to $61, which that high will be somewhere in the beginning of March, middle March. That's what we're somewhere in March of 2019. Okay, so we actually believe, just to reiterate, that we've actually hit the low, at least for now. We look at momentum, guys. One of the things we look at is momentum, which is not being shown on here. Just momentum indicators. You can use those if you any basic charting, even free ones online. You can check out momentum. Okay, but we look at from peak to peak. So think of it this way: right, a peak here, we're going to come down and we're going to come back up somewhere. Okay, now in between we may get some jagged, choppy stuff going on, but basically we're looking at a peak. I mean, look at this. There's peaks and valleys all over the place here, right? Peak, valley. Here's a peak, quick little valley, and then another peak, right? You see that? It's everywhere, right? Peak, valley, peak, peak, valley, tiny little peak, valley, right? It just, you can see it. It's even in uptrends, downtrends, you're going to get these peaks and valleys. So from peak to peak, okay. As a matter of fact, let me push out to March. So we're going to get March here on the screen for you, so you can see. Whoops. Look at the wrong thing here. Keep clicking the wrong thing. I'm trying. I'm trying. Let's push this out. So here's March, way over here. So let me find $61. $61. Somewhere right around here. Let's be a little conservative. Keep it right. Okay. Somewhere about right there, guys and gals. So this is what we believe we're going to get. That's what we think we're headed. That's just a modest increase. Now you may see some stuff like this and down and up and oh my gosh and up, whatever, but we believe by the time we get to March, this is where we're going to be, $61. Okay? Now again, we're not giving you advice to buy. We're not telling you need to get in right now. We don't do that. We're not financial advisors. We're not brokers. We don't do any of that stuff. Well, I'm simply telling you what we believe and how we're going to react and the type of trading we're going to do between now and then. Okay? And of course, if the market changes, then we're going to change our strategy, right? What we don't do is just put something in stone and say it can't change. We can't be wrong. No, we don't do that. We like to be honest with ourselves. We try to be transparent. We try to keep it real. Okay. As they say, we try to check the ego at the door. We put egos aside. Okay. So we're here to be profitable, enjoy making trades, and go about our business, right? Right. So there you go. We believe between now and March, we're going to see the price slowly increase. And there's going to be plenty of volatility between now and then, but we believe we're going to see a price increase all up to $61. All right. All right, everybody. Thanks for joining. I hope you really enjoyed this video. It's a free video. Again, subscribe to this YouTube channel because we're going to be coming out with a subscription-based service sometime probably in 2019. For now, we're going to try to put out a video a week at least. Keep you guys in the loop. Hope you enjoy the information you saw today. Again, my name is Jerry with H&J. Please feel free to leave any comments, and we'll talk to you again real soon, everybody. Bye-bye.